Have you ever made a mistake while investing? It's a common occurrence, even among the most experienced. The world of investing can be a labyrinth of decisions, each with its potential pitfalls and rewards. Today, we're going to navigate through this maze, focusing on the top 10 mistakes people make while investing. From investing without a plan to not starting early enough, we'll uncover these missteps one by one. So stay tuned to learn about the top 10 mistakes investors make and how to avoid them. Starting off our countdown at number 10 is investing without a plan. You wouldn't start a road trip without a map, would you? Similarly, investing without a clear and concise plan is like setting sail in uncharted waters. It's a risky venture that can lead to financial pitfalls. A well-thought-out investment plan serves as your financial compass, guiding you towards your financial goals while helping you navigate the unpredictable market currents. Without a plan, you're more likely to make impulsive decisions which can derail your financial journey. It's like trying to hit a target with your eyes closed. So, take the time to formulate a plan. Define your financial goals. Set a budget. Determine your risk tolerance. Identify potential investment opportunities, and most importantly, stick to your plan. It's your blueprint for financial success. Remember, a goal without a plan is just a wish. At number 9, we have ignoring investment fees. Picture this. You're making good returns on your investments, but you're not keeping an eye on the fees. Over time, they can slowly nibble at your profits, leaving you with less than you expected. Common types of fees include transaction fees, fund management fees, and advisor fees. These are like termites in a wooden house, gradually causing damage unnoticed. Now, how can you avoid these unnecessary charges? Start by understanding what fees you're being charged. Ask questions, do your research, and be sure you know what you're paying for. Then, compare. Look at other similar investment options and their fee structures. If you find lower fees for similar returns, it might be time to consider a switch. Remember, in the world of investments, every penny counts. Don't let the fees creep up on you. Every penny counts in investments, don't ignore the fees. Number 8 on our list is chasing past performance. It's common to see investors making decisions based on a company's track record. The logic seems sound, right? If a company or investment has done well in the past, it should continue to do well in the future. But here's the catch. The market is a complex beast influenced by a myriad of factors that are constantly changing. Relying on past performance is like driving while only looking in the rearview mirror. It tells you where you've been, but it doesn't show you what's coming up ahead. It doesn't account for shifts in market trends, changes in management, or unexpected events that can dramatically impact a company's performance. In the world of investing, there's a saying that rings particularly true here. Past performance is not a guarantee of future results. So, don't chase after the past. Instead, make informed decisions based on thorough research and a well-thought-out investment strategy. Coming in at number 7 is emotional investing. We're all human, right? And being human means we're prone to acting on our emotions. But when it comes to investing, that can lead to some serious pitfalls. You see, emotional investing is when we allow our feelings, whether it's fear, excitement, or something else entirely, to dictate our investment choices. Rather than basing decisions on solid research, facts, or a well-thought-out strategy, emotional investors might buy high out of greed or sell low out of fear, both of which can result in significant losses. It's important to remember that the market has its ups and downs, and reacting to every rise and fall with panic or greed can derail your long-term investment goals. So keep your emotions in check and let your strategy guide your investment decisions. Number 6 is not diversifying. Picture this. You have a basket of eggs. If you drop that basket, all your eggs break. But if you distribute your eggs into several baskets, dropping one doesn't mean you lose everything. That's the essence of diversification in investing. It's about spreading your investments across a variety of assets, so that a downturn in one area doesn't wipe out your entire portfolio. Think stocks, bonds, real estate, and even different sectors within these categories. By diversifying, you're essentially hedging your bets against market volatility. It's like having a safety net, ensuring that your investments can withstand the ups and downs of the market. Remember, there's no such thing as a surefire investment. Even the most promising stocks can plummet, and the most stable bonds can dip. Diversification is not just a buzzword, it's a crucial strategy for risk management. Halfway through our countdown at number 5 is neglecting to rebalance. Just like a well-oiled machine, your investment portfolio needs regular maintenance to keep running smoothly. This means from time to time you need to rebalance your portfolio. Rebalancing is the process of realigning the weightings of your portfolio of assets. It involves periodically buying or selling assets in your portfolio to maintain your originally desired level of asset allocation. For example, if one of your investments is performing exceptionally well, it might start to occupy a larger portion of your portfolio than you initially intended. This could expose you to more risk than you're comfortable with. Failing to rebalance could also mean missing out on potential returns from other investments. So don't let your portfolio ride on autopilot. Make sure you give it the attention it deserves. Remember, your portfolio needs regular checkups too. At number 4, we have timing the market. This is a common pitfall where investors attempt to predict the market's highs and lows. It sounds like a smart strategy, right? Well, not quite. It's nearly impossible to consistently predict market fluctuations. Even seasoned investors and financial analysts struggle with this. Trying to time the market can lead to potentially detrimental decisions. You might end up selling when you should be buying and vice versa. It's like trying to catch a falling knife. More likely than not, you'll get cut. Remember this. Investing isn't about hitting a home run with a single stock. It's about growing your wealth steadily over time. The most successful investors understand that it's not about when you invest, but how long you stay invested. Don't let the fear of market volatility deter you from your long-term financial goals. Stick to your investment plan and ride out the market's ups and downs. When it comes to investing, time in the market beats timing the market. The third most common mistake is not understanding your investments. Imagine you're a chef. Would you whip up a dish using ingredients you know nothing about? Probably not. The same principle applies to investing. You wouldn't want to put your hard-earned money into something you don't fully comprehend. It's crucial to understand the nuts and bolts of your investments, including the risks involved and the potential returns. Each asset class, whether it's stocks, bonds, real estate, or cryptocurrencies, has its own set of rules, risks, and rewards. A basic understanding of these factors can help you make informed decisions. Remember, knowledge is power. The more you know about your investments, the better equipped you are to navigate the financial markets. This doesn't mean you have to be a Wall Street whiz, but you should at least have a solid grasp of what you're investing in. It's simple. Invest in what you understand and know. Our runner-up mistake is ignoring inflation. Now, let's talk about a subtle yet powerful force that can slowly erode your investment returns: inflation. Imagine this. You've stashed away a tidy sum for your golden years, only to realize that what once bought a luxury car now barely covers the cost of a used sedan. That's inflation at work. Inflation reduces purchasing power over time, which means the same dollar amount buys less in the future. So, when you're planning your investments, it's crucial to factor in inflation. Your returns need to not just match, but ideally outpace inflation to grow your wealth in real terms. Think of it this way. If your investments are growing at 4% per year, but inflation is at 2%, your real return is only 2%. Quite a difference, isn't it? Inflation is the silent killer of investment returns, don't ignore it. And the number one mistake investors make is not starting early enough. Here's a fascinating truth about investing. Time is your most valuable asset. You see, the sooner you start investing, the more time your money has to grow. This is all thanks to a magical phenomenon known as compounding. Simple put, compounding is when your investments earn returns, and then those returns earn returns, and so on. It's like a snowball rolling down a hill, gathering more snow and growing larger as it goes. The power of compounding is magnified when you start early. Even small investments can grow into substantial sums over long periods. Consider two people. One starts investing at 25, the other at 35. Even if they invest the same amount of money, the one who started at 25 will likely have significantly more at retirement. This brings us to a crucial point. The best time to start investing was yesterday. The second best time is now. Don't delay your financial future. Start today and let time and compounding work their magic. That wraps up our countdown of the top 10 investment mistakes. We've journeyed from investing without a plan, right up to the importance of starting early. Each misstep holds a lesson, a beacon to guide us towards improved investment outcomes. It's our hope that these insights will help you navigate the investment landscape with increased confidence and wisdom. Remember to like, subscribe, and share this video to help others avoid these common investment mistakes. Until next time, keep investing wisely. The information provided in this video or communication is for informational and educational purposes only. It is not intended as and should not be considered financial, investment, legal, or tax advice. The content is based on general principles and may not be applicable to your specific financial situation or needs. Always consult with a qualified financial advisor, accountant, attorney, or other professional before making any financial decisions or taking any actions related to your finances. Any investments or financial decisions you make are solely your responsibility. Past performance is not indicative of future results, and there are no guarantees of any specific outcomes or returns. While every effort has been made to ensure the accuracy and completeness of the information provided, we do not warrant or guarantee its accuracy, reliability, or suitability for your individual circumstances. We do not endorse or promote any specific investment products, services, or strategies mentioned in this video or communication. Any references to such products, services, or strategies are for illustrative purposes only and do not constitute a recommendation or endorsement. You should conduct your own research and due diligence before making any financial decisions. In summary, this video or communication is not financial advice, and you should not rely on it as such. It is essential to seek professional advice tailored to your specific financial situation and goals before making any financial decisions or taking any actions.